chart examples, and it'll be a good time. So let's get into it. All right, and present mode. There we go. There's our man. Look at him. What a dog. All right. Bulkowski is quite a trader, and we're going to talk about why his patterns really work. But yeah, let's talk about what we'll be covering here. Introduction. We'll be doing what we're doing here. We have some really nice patterns. We have a couple for continuations. Those are best traded in bull markets. So we'll be talking about how valid they are in the current climate. I know it's been a crazy day. I hope you're all doing well. I know it's stressful out there right now, but we'll get through it together. We're also going to be focusing on a couple bottoming patterns or reversal patterns, and I think these are going to be more relevant for our current market climate. So it's a good time to talk about them. Going to hit some key takeaways, and then we're going to have a Q&A session for you guys. So let's get into it here. Who is Bulkowski? He was a former engineer, very successful in his trade, and then he started trading as a hobby and just kept growing his account and doing better and better. And it's really his calling. He's written a lot of great books. The most well-known is this Encyclopedia of Chart Patterns. It's a really nice coffee table book. It's great to have around. You get so many great visuals, and it's just a really good buy. So I'd highly recommend it. He's really focused on quantitative analysis in the sense of using a lot of data, always falling back on statistics and probabilities. And I don't know if anybody caught my webinar last week, but that's what I'm all about, right? We're about defining risk and looking for those max rewards for that defined risk. So yeah, he's researched over 500 patterns, and I'm going to give you my 5 favorite. There are a lot of other good ones, and I'd recommend checking out his website as well. I'll drop the link later. Yeah, it's really good stuff. I'm often not a huge pattern trader, to be completely honest with you, because, patterns, they can be really trappy, especially certain ones. Like how many times have you bought the flag and it just fails on you, right? It's a very frequent occurrence, I will say. So that's why I lean heavily on the ones that are backed by statistics. And I kind of leave the rest, for the rest of the traders. Everybody has their favorites, but we're going to talk about mine. So why do we want to trade these patterns? Like I said, it's all statistically validated. This is the big thing for me. I'm just going to hammer that home. Clear rules for entries, for stops, for profit targets. We're going to talk about those profit targets and how we calculate them. It's really good. It's very calculated. It's good stuff. And, this stuff works in all asset types. So, we'll see the same patterns repeating, whether you're trading Forex or equities, crypto, NFTs, probably. Maybe not NFTs, but hey, you never know, right? Because price always works in the same way, because it's always supply and demand. So that's what we're here to kind of analyze and dig into. So let's jump into it. We've got the classic ascending triangle. Pretty simple pattern. I know you've all recognized this. You have the flat horizontal resistance. You have the rising support. And what does that tell us, right? It tells us there's a seller up here, but the buyers keep buying at a higher price. That shows a real demand and a rising demand. So we have at least 3 touches of the flat top. The next part's that rising support line we mentioned. And then the third component here is a declining volume. And that's as the price coils. So that again is showing that demand is drying up, that supply is drying up. So there's less and less people who are willing to part with their shares at a lower price. People are willing to sell down here this time, but next time it's a little higher. Next time they're buying up here. And eventually it's just a coiled powder keg that just explodes. Ideally, it works about 79% of the time based on his numbers. And, he's got a pretty significant data set that he's working with here. So really good stuff there. And let's talk about how we're going to trade him. We are going to buy the breakout above this resistance, this flat top here. And the stop loss will be under the most recent swing. So you're really minimizing risk. There's not much risk on the table. And what you're targeting is a move the size of this biggest low to the base high. So it's at least a 2-to-1 reward, risk reward usually. And that's what I always shoot for, at least 2-to-1. If it's not giving me the odds, I don't want to trade it. There's too many charts out there in the market to waste your time on stuff that isn't the best of the best. That's my belief. So some pitfalls that you can encounter. You can really get false breakouts if there isn't a nice pop in volume. And I think that's going to be one of the things that you'll find is a recurring theme with a lot of these patterns. We always want a confluence between volume and price action. So we have a big green candle, we want to see big green volume. If there is a divergence there, that's a red flag. So that is just about across the board, no matter what pattern you're trading. You always want a confluence between volume and price action. So another thing that can get you in trouble is trading these in downtrends like we're currently in. So, fair warning, if you go out and see an ascending triangle, doesn't necessarily mean pull the trigger. There's always the factor that trends tend to continue. And if we're in a downtrend, there will be a lot of trappiness. And that's why I was talking about how I'm not a huge pattern trader in general, because often you will get bullish small patterns in larger bearish patterns. So it's always important to zoom out. It's always important to work your bias from the higher time frames in. That's really, really key. So here's a nice chart. It's the same one that we just showed, but we got the full picture here. So Apple, weekly chart, each candle's a week. We put our stop right under there. We enter on the break here, and it's on above average volume, breaking this downtrend. It's honestly not super, super big. We would like to see 1.5 times average volume, which would look a little more like up there, but clearly it worked, right? So there's no hard and fast rules, but we're always looking for general rules. And what's our target? It is the same as the high of the base to the low of the base, about 23% in this case. So as you can see, just easy trade right up in there. And I believe it chops and continues because mega caps, Apple, you know how that goes. Well, until recently. So good example here. And we're also going to look at a failed breakout here. This is Altria MO. And we have the same classic pattern. It looks really good if you're not looking at the volume, right? If you're just looking at this, it looks pretty solid. So yeah, it's good stuff. But what is it missing? When it's chopping up here, there's really no significant volume, especially on the green candles. They're not breaking out. So when I see significant volume on red candles, that's not really what I want to see on a breakout, And as you can see, that significant red candle here aligns with this attempted breakout and rejection. And it does have big green volume here, but what did we see? No confluence with price. No big green candle. And so that's a big warning sign. As you can see, just rejects pretty hard there. So good example to kind of illustrate the points we've been talking about so far. Moving on, we got probably my favorite pattern ever. The cup and handles are just so beautiful. You love to see it. The perfect cup, the perfect handle, and just boom, right out of the gates, you usually get a really clean move. So this is always one that I'm looking to trade. This is a continuation pattern. So in this cup, we're seeing a massive move up, and then the continuation is out of this handle. What we're seeing is a huge base forming, and then a retest of the base, and then a breakout of the base. So we got that U cup that we mentioned, smooth decline and rise. They're really, really, really clean most of the time. Like, this one's, I use this example because if it isn't the most beautiful chart you ever seen, I don't know what is. This is BSX on a monthly time frame. Excellent trader, just boom, out of the gates, went crazy. This is like half the move. But for our purposes, we are targeting, just like in his other patterns, the bottom of the base to the top of the base. And then we double that. So this move projected upwards. So the handle drifts downwards about 1/3 of the cup's advance. It can go down to 50%. As you can see, it did briefly test it. And this is why I love Fibonacci ratios. If you throw these on your charts, it's like a whole new world opens up to you, I swear. It's really cool to see how often they interact on an algorithmic level. So this one had a brutal knife, but what does it do? It shows strong buying incentive right here, and the weekly candle closes right up, about 1/3 of the way up the cup wall. So good stuff there. And as we'll see on the next chart, when I zoom in and show you the volume is going to dry up in the handle and then surge on the breakout. So let's look at that. Well, I'm sorry. First, let's talk a little bit more about the trading plan. So we're going to enter on the break of this handle, the neckline there, and often it'll line up perfectly with the cup. So you got nice 3 points of contact and surging through. Stop loss goes right on the lowest point of the handle. So you could say here, I put the stop here. That's what I would trade it. Personally, I think that it shows that there's a consolidation here. And when you're at this point entering the trade, you can look at the most recent swing low. So there is a little bit of an art to this. It's not 100% science. It's kind of like, you know, cooking versus baking. You know, baking, you got to have all the right ingredients in the right order. You get some flat cookies. But, you know, cooking, you can throw this spice and that spice, and it, you know, it can really work out. So we've got some pitfalls. Retracing, handles retracing more than 50% of the cup shows a weak pattern. Every once in a while, you'll get that 50% retrace and it undercuts and it still breaks out. But more often than not, it's a warning sign, and that's like a big red flag for me. Doesn't mean I'll never trade them, but it's taken my interest from like a 8 or 9 out of 10 down to like a 4 or 5, 6, something like that. So cup can be too deep too if it's more than a 40% decline, or if it's like really V-shaped. If it's a really V-shaped move, it's not the same pattern. We do have another pattern that does show the V shape, and you'll see that later. It's good stuff. It's actually one of my favorites, but you know, it's just not what we're looking for this chart to play out. So, oh no, it cut off my volume. I'm sorry about that. I can guarantee you that there is declining volume here, and especially here in the handle. That's where we're really looking for it, and you'll see that in the next example. The declining volume in the handle shows the same kind of principle we're talking about with that ascending wedge pattern. And that is essentially that supply is drying up in here. Whereas before we had this big range, went from this high all the way down. Now we're just getting a smaller range, you know? So that's showing that people are incentivized to buy it higher and higher and chase it up as it breaks out. And that's really what we're looking for here. We always want to trade with institutional volume and we trade with the pack, so to speak, you know, especially for these kind of momentum breakout type patterns. You know, what would you call it? Mean reversion strategies are totally valid, and my scalping strategy actually revolves around that primarily. But when I look for these swing trades, I'm looking for big moves with minimal risk. So risking very little, we're targeting a very, very aggressive target. Does that mean we have to hold this to the target? No, of course not. You know, things could always change. We could always see maybe this consolidation posts a really ugly weekly candle. Maybe we take some off there. Ideally, it happens up here or something, you know, so we get a nice move. But in general, this is the projected target. Doesn't mean you have to ride it all the way. I think we've all been there where we're like, we have it in our head. This is the target. And it just doesn't quite kiss it. And then we end up U-turning and, you know, closing flat or God forbid red. But with this kind of strategy, you can really focus on once the trade starts working, you can let it work and you can just keep on moving your stops up to whatever you're comfortable with. Everybody's got their own strategy. Everybody's got their own comfort level, risk tolerance. And it's really important to know that about yourself as a trader. So as you keep doing this, you'll start getting more comfortable and kind of hone in on your edge. And that's what I'm all about. I'm telling you my edge here. You know, this is the stuff that I trade, but it's super key to know yourself and what works best for you. So here's an example of one that just didn't quite work. It's really a bummer. I was actually in this trade. I thought it looked really good. There are a lot of macro factors. This is a tanker company trading along with oil and geopolitical risk. So that's kind of a red flag too, right? It's often better to trade in sectors that are stronger. If the sector isn't strong, there's a good chance the pattern will be one of the 20% that doesn't work, 21%. Oh, I think this has a 68% win rate. So, you know, a little bit more than that. But, you know, ideally we're trading in the strongest sectors and we're finding the best patterns in those sectors. So we have the cup, we have the handle. It totally obeys the rule of the Fibonacci's. It doesn't dip below the handle or below the 50% here. And really quick, let me talk about why that's so important. So when you have a trading range, that 50%, that represents the fair value, so to speak, of that range. If you do dip below it, you want to see really strong buying power there. Like if you're holding a beach ball underwater. And the idea there is that's the first time that it's trading at a quote unquote discount. So if it's trading in a discount and it's not getting bought, that's a problem. You know, if you see some candy on the shelf and they keep slashing the prices, you know, that might not be the best candy if nobody's buying it, right? So that's the kind of idea there. I think fibs are super key and crucial. And, you know, if you guys are interested, maybe next week, that'll be what I focus on. I love trading fibs and there's a ton of information you can learn about them. But for the sake of this conversation, let's just focus on the cup here. We did get a breakout here, anemic volume, and it just fell off the face of the earth. And, you know, it's really a bummer, but, you know, this is part of the game we play. They don't all pan out. So these are cup and handles, really great pattern. Just to recap, we look for the big cup, a smaller handle that's usually a third of the height of this, could be down to a half, and then we look for volume on the breakout. Moving on, we got our nice V pattern here. So this is called an Adam and Eve double bottom. Fancy way of saying it's a double bottom. What is a double bottom? Great question, you may ask. What we got for a double bottom is one kind of capitulation event, one sharp move down, and then it recovers. And then it shows that this move was overblown. How does it show that? Because it doesn't dip as far as it does. And importantly for this pattern, it shows that it is not, it's smoother, right? It's not as, it's lower volatility. It's not as jagged of a move. This is the capitulation shakeout. And then there's a mean reversion. And if we slapped a fib here to here, I bet you dollars to donuts that this is right about the 50% move where it failed. So goes down, sharp V, and then a nice smooth curve here. So that's what we're talking about here. Sharp V, rounded bottom on the eve. And then the eve bottom is often 1 to 3% higher than this sharp bottom, the Adam bottom. So it's not always going to be 1 to 3%. If you're trading something with a high ADR, a high average daily range, a big fast mover, maybe a micro cap, then you're going to have some bigger differentiation in terms of percentage. So it's not a hard and fast rule, but generally with like NASDAQ 500, S&P 500 or NASDAQ companies, this is often what you'll see, this 1 to 3% higher second low. So the volume is going to be heavier on the eves rise. As we can see, there's, let's see right here, we got some nice breaks of average volume here. And in general, on the Adam rise, it's going to be lower than average volume. And, I do think that average volume is a better way to look at this than like strictly, the amount of shares traded on a given day, because it's all about that rolling average. It's always about like what recent traders are doing, compared to other recent traders, essentially. You're kind of gauging relative strength. You'll hear that term a lot. Relative strength is super key in all of this stuff. So these have a 75% success rate. They're really reliable. And they are our first bottoming pattern here. I think this is important because this is what we're going to be starting to look for in the upcoming weeks. I am a bear. I will not sugarcoat it. I think we're going lower. But when we stop going lower, I'll be looking for a sharp bottom and then a rounded bottom. Not saying you can't trade this. You can catch some really good moves. But for the long-term reliable swing trades, when you say, all right, we've dropped enough, I think we have a solid foundation for a move up, this is what I'm looking for. So what's the trading plan? You enter on the break of this neckline. This one's a little sloppy. These aren't always perfect. I'm using imperfect examples because I think it paints the picture better. I think it's better to see, like, in the real world, there's a lot of shake and bake. There's a lot of volatility, just kind of how it is, right? So, I think it's a trap that pattern traders get into where they're like, the pattern's not perfect. It's invalid. And then it moves a crazy amount on them and they're sitting there shaking their head like, what did I do wrong? Usually it's rigidity, it's always, like I said, it's an art, not a science. There is a lot of scientific components in it, but at the end of the day, the market loves to do what hurts the most people. It'll love to run stops. It'll love to overshoot. It'll love to barely kiss your stop or kiss your target, but not quite, because they know people are all looking at that level and they get front run. It's a very dynamic game that we're playing, and we got to stay on our toes. So that's the trading plan for these. And what are the pitfalls? If the eve, the second bottom, undercuts the Adam, that's invalidating this pattern. Does it mean that it can't go up? No. I actually trade a different pattern that's called a failed breakdown, which is where, you have one low and then it comes lower and it sweeps those stops, just like we were talking about. It makes all the people who got long up in here mad because it comes back and reverses on them and they're all out of the trade, and then new buyers step in. So that's valid, but it's not valid for this pattern. For this pattern, if the eve undercuts the Adam, then we're looking at higher volatility on this second one. It's not the smooth look that we're looking for. The smooth look is what gets really nice, consistent moves. Another thing is the neckline is too steep. Say this whole pattern was like tilted at an angle or something, it's just a whole different animal at that point. We really love horizontal resistances. Because they are more reliable than trend lines, diagonal trend lines. And that's because we can just know that there's orders on the book there a lot more consistently than, there's a lot more guesswork when you're playing with the diagonal line. So just something to consider. A lot of these little tidbits I'm throwing in aren't necessarily specific to any one pattern, but it's just good stuff to know. Good stuff to know. So here's that chart expanded. We have the sharp V bottom, the nice rounded curve, targets up here. We see a big, powerful move out of the breakout. You would be buying on maybe this candle, a green close above the neckline. You get a pretty instant move up. I would personally be taking profit here. If we look at the right side of the wall or left side of the wall, we see some gaps and we see a big doji into the gap. So personally, I would take some off here. But if we're just trusting the plan, trusting the system, then where's our stop? Right under here. We get yeehawed a little bit, it does come back. And as it so often happens, this expansion with the gaps comes back and gets filled in there. So, often you'll see the gaps fill in because when these gap up, there's orders on the book that never got filled. And market makers get paid on the amount of orders that they fill. So it's almost like a magnet going for these gaps. That's kind of the psychology and the mechanics behind gaps. They love being filled because there are empty orders, or orders waiting to be filled, just sitting there. So it smashes up, smashes down, a little bit of a yeehaw, comes in, but it never breaks this low. And why that is because there were buyers waiting here. They're not waiting down here. This is old news. This is already confirmed as a bottom by this kind of breakout here. Shows that there's a lot of people who want this thing. I mean, it's Berkshire, right? This is a very quality name. That's another thing that you can add to your confluence. Quality names are more likely to go up. Micro caps and a lot of the stuff we day trade that are fun, don't get me wrong, but they're not as good for investments or for longer swings. So just something to keep in the back of your mind there. But since then, we just rip straight up and we hit our target. And what's our target? It is twice the length of our lowest bottom. So the atom bottom, the first bottom, and that's going to the neckline here. And again, this neckline is a little arbitrary. You could argue it could be a little higher or lower, but I think this is pretty clear, especially in this consolidation into it. So that's why I drew it right there. Here is an example of one that just didn't work. So it's Bitcoin quite a while ago, as you can see, trading under 10K, but we all wish we could buy this, right? So we have the sharp V, we have the curve bottom. This is looking really good. I was looking up examples of Adam and Eve setup, and not even a failed one. And I saw a good amount of old blog posts that were all looking at this and saying, oh man, we're going to the moon. And didn't quite pan out. It didn't quite pan out. And I'm going to give you just a second while I take a sip of water and see if you can identify what happened here. All right. Don't all jump at once, guys. I'll tell you. The breakout attempt, this rough neckline, didn't draw it here, but I think you can kind of see it, right? Comes down, there's another tap, here's consolidation into it, and it tries to break out. It does have decent volume, but what do we see right after that? What's the kind of defining characteristic in this volume box here? I don't know about you, but it looks like a big red middle finger. Yeah, exactly, Stuart. Volume. So the volume tells the story. When you have a medium green candle volume and then a giant red candle volume, that's a red flag. That's a red flag. And what does it do? It even runs those stops, takes out people who are short here, just because, hey, screw you guys, right? The market loves to run the stops. But the trend is very clear after that. This was not a valid pattern, because if it was, we would see an incentive to break out of this pattern. And when the volume is like this, it really tells a story. So that's a big key takeaway. Volume tells a story. Oh, that's my face. Wrong tab. All right, we're back to, there we go. Could that high red volume signify seller exhaustion? Let's see. So I would say, let's talk about that. There is validity to that question. It is a good question, right? So when you're talking about seller exhaustion, you would generally like to see that after it breaks a range. So for example, if we saw this big red candle up here, it swept these highs, and then it would be buyer exhaustion in that case. So that's something important to remember, to keep things in the context of a larger range. So here we're trading in the middle of a range, right? And where do we see the red come in? Right in the middle of this range. I bet you anything, back to those fibs, this is right around the mid 50% of this current trading range. So we come up in this trading range after forming it, the high and the low. We come up to halfway and then boom, big red candle, big red volume. We have that confluence there. So it's a great question. And this is, like I said, it's an art. I won't say 100% no, it can't be that, or yes, it can be that. There is a lot of interplay. And, I'm like everybody, I'm still learning. I've been doing it 5+ years, but I still learn every single day. And that's really important to stay humble, right? We are all part of a very complex machine, a very complex system when we're trading. And it's always good to check your ego at the door, I'd say. So bump and run patterns. These are fun. So a bump and run pattern has about a 72% success rate. And here are the kind of key characteristics. You have a declining line, declining neckline, and it can be, there's, like I said, it's an art, usually between 30 and 45 degrees. So between like a complete like this and something like that, right? That's kind of what we're looking for. So it has this pattern, it's trading under it, it bumps it, gives a nice bump to the trend line. You'll see on the bigger chart where this kind of comes into play. And then it dumps. Bump, and it dumps. So we got the bump. Where's the run? The run comes when you break back above the trend line. Usually there will be a little bit of a consolidation range here before it really takes off, but that's kind of the general things we're looking for. Sharp rally, then violent drop back to a trend line, and then it breaks the downtrend with volume surge. So as it breaks here, we have a nice pop above average volume. Then in this box here, it's consolidating, right? And what do we like to see in a bullish consolidation pattern? We like to see that declining volume because that shows us that supply is running out. I know I'm repeating myself, but it really is important to kind of hone in these ideas so that when you see declining volume after a big move, oh, that's good. That's good. That's probably going to lead to continuation. This is where I want to be looking to buy. You could buy on the trend line breakout. Maybe you add when it gets super tight here. So I want to talk about this really quick. You see this red candle, the one right in between the green? It's the lowest volume candle in the consolidation. And that's what's called a trigger bar. And it's really, really fun to trade because very often it gives you amazing entries because it's saying like things are getting so tight. We have confluence between the volume size and the candle size. Really tight candle there too. So that confluence is great. We have the prior bias of an uptrend. We have the larger context of the candle pattern we're trading, the chart pattern. So all these things come together and say, obviously it's easy to say right here when you have the whole picture, but this is a very clear buy entry on that little red candle right there. Even the way it closes, it opens here, pushes down, comes back up and closes at the high of the candle. That's good stuff. And after that, big volume pop and a lot more higher than average volume, especially as it starts cooking there. All really good signs. So trading plan here. We enter on the break of the downtrend like we talked about, and our stop is under the bump. So I will say this is a great trading pattern, but it does have a wider risk than some of the other ones. It's not like my top pattern for that, but when I see it, I do keep an eye on it, and there'll be some with more or less severe bumps, and that's a good often those will give the best risk reward in these patterns. But just something to keep in mind, the stop is pretty wide here, and it's always a bummer when you get one of these and then it just whoop goes right back down on you. We've all been there. It's really important to be able to kind of take your lumps and know when it's time to hold them, know when it's time to fold them, all that good stuff. So the reason why we're trading this is because the target is 50 to 100% of the lead-in decline. So you can get some really, really big downtrends, and this is the bottoming pattern. So you can catch really big uptrends because of that. So let's look into this a little bit deeper here. Well, first let's talk about pitfalls. I gotta remember my plan here. Always remember your plan. So pitfalls are confusing these with dead cat bounces. And we'll talk about that a little more with the failure example. But a dead cat bounce is an up move in an overall downtrend. So we gotta make sure that we're out of the downtrend. And like Daryl was mentioning with seller exhaustion, this is a really good example of seller exhaustion. So we have a big red candle and it sweeps out the current range. So this is where the sellers they all got out. They're all saying, all right, we made our money. we were targeting the low of this range or maybe lower. Looks like we got about a measured move from the high of this little range, the high of this little range down. And I see some sad cats in the chat. Oh no. Dead cat. Yeah, there you go. Anyways, we sweep it out, and what do we see? High volume here. So you can say this is buyer capitulation. They're saying, all right, you got me. I can't take more pain. I'm out. And then declining volume, like we're talking about, and constructive price action. So these are all things that you can start to look for, right? All things that you can start to kind of build together to build your confluence, because that's the difference between a pattern being successful and a pattern being unsuccessful. You can like hone in like certain scans to kind of eliminate some of the manual analysis, but really I think it's always best to really look at it yourself and to kind of hone your eye. And that's what we're all about, right? We're trying to get this to be repeatable and something that you can just quickly scan through tons of charts and just say, I like that, don't like that, like that, don't like that, and kind of get yourself baskets of things that are looking good. And this is a great time to start doing this because we are in a downtrend, but we won't be forever. When we are ready to move, we want to know what names are looking ready and set up. So just something to keep in mind with these reversal patterns. All right, here is yet again our favorite, Bitcoin. It's a really clean example, and man, does Bitcoin move well when it goes. This actually appeared right after, or relatively soon after, that Adam and Eve failed bottom that we talked about a few minutes back there. So we have a big move up after shaking out everybody on the Adam and Eve bottom with the failure. And what do we have? We have a decline. It's about 35 degrees, give or take. And what do we see? We see a bump up into it, and then it dumps and runs these stops down here. And like we talked about, big capitulation volume. Up, up, up. Target is about double the bump. And you can say like double this. It could go even double the full base here. And Bitcoin, I think this thing tripled on this move. So these are really, really powerful patterns here. When they break, they really break. But let's talk about one that didn't work. This is Wish. When you have a ticker named Wish, it's kind of wishful thinking, right? I think that's nominative determinism, something like that. Anyways, we have the decline. We have the 45-degree downtrend here. And we have the bump. It's almost a bump here too, but here's the bump. And, again, not a science. You could maybe draw this a little steeper, but I think that this is pretty fair. We have the bump, and then we'd put our stop under the bottom of the bump. As you can see, no run, sad face. And I'm not sure why why a few of my charts cut off the volume here. I apologize for that, but I promise you there was very underwhelming volume on this pop. You can pull this up. It's I think 2021, early 2022. That's when it was. And man, it was a sad day. I know a lot of people were looking for a bounce in this, and it just did not play out. This thing just bled and bled and bled for so long. So it's important to respect your stops, right? Not too bad to lose this. If it goes down 100 or not 100%, if it goes down 50%, you're going to be really crying. And the other big part of that is you're losing mental capital, you're losing actual capital, but you're also missing out on the opportunities to find valid setups. So always respect your stops. Okay, let's see. We got head and shoulders bottoms here. I see my link broke there and it's showing an old chart. I apologize. We have more examples, but let's just talk about really quickly how to identify. We have a 65% success rate, and the left shoulder and the head are on high volume. The right shoulder is on lower volume. So remember again, when we have the consolidation towards the breakout, we want to see low volume. We want to see that compressing really tightly. And then the neckline break, it requires a volume surge. This is the wrong chart. Let's find the right chart. Oh, they broke on all of them. I'm sure they'll be there for the chart examples. Let's talk about the trading plan really quick. Close above the neckline, stop below the right shoulder, head to the neckline distance, projected up. It's kind of hard to visualize, so let's get the chart going. Okay, I'm just going to pull it up manually here. NVIDIA. Let me switch my tabs. Get to see my beautiful face real quick. Thanks for bearing with me here. Sometimes this is how it goes. Present. Let's see, I'll have to stop my screen real quick. Don't worry, I'm not going anywhere. There we go. Now we're cooking. Okay. Live charting here, boys and girls. Welcome, welcome. So NVIDIA head and shoulders bottom here. What do we have? We have the left shoulder. Got this clear neckline. Oh, there it is. There it is. Live productions. Thanks for bearing with me. Left shoulder, head here, right shoulder. We got the neckline going on. It's really clear and defined. We got 1 tap, 2 tap, 3 tap, 4. Great to see. Oftentimes with trend line tests, 3 is the rule, 4 is a gift. So just something to think about. If you get that 3rd tap and then it looks really tight, we see that declining volume, you're cooking. You're cooking. Start looking. So we have the shoulders. We have lower than average volume on the right shoulder here, higher than average, breaking above this moving average on the left shoulder and on the head. Really clear bottoming pattern, really, really pretty. And I think we all know what happened with this one, right? There it goes. All right. This is actually from my last seminar. I used the same chart for VCP stuff. So if you like what you see in here, we have a really nice presentation from last week, but I won't bore you with that. Let's talk about this one. So target, twice the height of the head. Just project that. And actually, since we're on TradingView, we can just do this. And as you can see, boom, right there. And it's like magic, guys. These things are algorithmically programmed. It's not just me and you watching for these measured moves, as they're called. A measured move is one range projected upwards. And what happens up here? We see sellers step in for the first time. So it's very, very calculated, this stuff. When they work, they really work. So great example here of a head and shoulders, and this is technically an inverted head and shoulders or a head and shoulders bottom. Often people will talk about head and shoulders as a negative thing. And hey, look at there. We kind of have a right shoulder, a head, and a left shoulder there, and then boom, breakdown, right? So just always keep in mind which side of the spectrum you're looking at here, but the great pattern in either way. Although this is interesting. Why I chose this pattern and not the traditional head and shoulders is because these actually have about a 15% higher win rate. Head and shoulders in the other direction is kind of a coin flip, and I don't like coin flips. I like easy money, and this kind of move is easy money, right? It's good stuff. See, our very own VSync says, interesting to compare with this current inverted head and shoulders, his bullish step 2 reversal. Oh, look at that. You can pull it up on screen. Production value. His bullish 2-step reversal we discussed at lunchtime in Discord. How about that? We're bringing it all together. So this is what trading is all about, right? It's about building confluences. It's about saying, oh, I know this from here and this from here and this from here. And they're all building into a bias for a direction of a stock. It's really good stuff. Whoops. That's not what we need. I don't think anybody wants to look at Amazon right now. That's rough. So I'm going to stop sharing this and switch back to the presentation. There's my face again. And there's my broken tabs. So we are reaching the end here. I just want to kind of hammer in a few more key points. We always wait for the volume confirmation. It's super key. And I'll just add to that the confluence between volume and price. So big green candle, big green volume, big red candle, big red volume. If we're in a consolidation range, small candle, small volume. It really is that intuitive sometimes. We only trade continuation patterns. A continuation pattern is one that goes up, bases, then goes up more. So like the cup and handle we're talking about, or the ascending triangle, we only trade those in stage 2 uptrends. A stage 2 uptrend is just the expansion part. Stocks all have 4 stages. You have stage 1, consolidation or accumulation. And then you have stage 2 when it breaks up out of that accumulation. You have stage 3, the topping process. And that is also also consolidation, but it's just bearish consolidation. And then you have the big move down, which is what we're starting to see in a lot of stocks. I will actually give you one more example of the staging patterns. I think it's a really good one. Let's look at SMH. This is one that I'm trading right now. So I've been, if you're in my Discord, you've seen me post this chart a billion times. I know, bear with me, but it's really important. Stage 1, accumulation, trading in a range, boom, we mark up. We stage 2, we're breaking out and accelerating. Back to distribution or consolidation, whatever you want to call it. And then we have this range and we're breaking down out of it. So I would expect sharp move down back to the accumulation. Everything's a sine wave. Everything's a cycle. This is, if you look back in charts of, I don't know, the Indian ship company, trading company, from the 1700s or whatever, they do the same stuff. Some things just don't change. So I heard, was that Tim laughing? Yeah, he knows about that chart. So yeah, it's good stuff. And this is replicable time in and time again. Oh, I'm so sorry. I'm not showing the chart. Thank you very much. There it is. Bear with me here. Accumulation. I'll go over it again real quick. Thank you guys. Apologies there. Apologies. I'm still getting new to presenting, but not new to trading. So accumulation in this range, stage 1. And then you have the markup. So that's stage 2, the breakout of the accumulation. We have the distribution, more choppiness, mixed tape, so to speak. And then we're starting this distribution process, stage 4. So we are only trading those continuation patterns when they occur in this part of the chart, right? And as you look here, this is a cup and handle, and it is a continuation pattern. We're going up, we make a cup, make a handle, boom. I didn't plan that. They jump out at you. I'm telling you, they jump out at you. So this is a really good example. We're going to switch back and talk about the very last point, and then I'll take some questions. So if you have any questions, feel free to drop them in the chat. I love to answer them. I can't promise that I can give you the best answer every time, but I will do my best. There we go. Bulkowski's rule of height rule for targets. So this is just what we were talking about, where you take the measured move of a base of a pattern to the top of the pattern, and you double it. It's that simple. It just works, guys. It just works. I'm telling you. So I think we've covered a lot of good ground here today. I really appreciate you guys bearing with me and the few technical details there that I need to iron out for next time, which I promise I will. But yeah, this is good stuff. And this is, like I said, very replicable, very repeatable. You'll see it time in, time again, year after year after year. So yeah, thank you so much. If anybody has any questions, feel free to drop them. I'll hang out for a minute, and I'm just going to get some more water and then take a look at the questions. I'll be right back. Alrighty. Let's see what we got. Could we review Palantir? Yeah, sure. I'd be happy to review Palantir. And Stuart, I see you have a question. I'll get to you right next for sure. And I'm also going to just scroll back and see if I missed anything. Miss Lucia asks, can you see this pattern set up on any stocks at the moment? Let's see. If you're still here, feel free to remind me what pattern we were looking for, and I'd be happy to give you some examples. It was about half an hour ago, so probably the early one, probably ascending triangle. Let me see if I can think of any of those. And while I do that, let's look at Palantir. Fun stock for sure. I have some good lines for you. Good crayons, tasty crayons. Everybody likes a good crayon. Let's take a look. Okay. Daily chart on Palantir. What do we got? We got some good levels, Man, what a mover, right? This is such a crazy stock. When you get these trends, it's you just grab a piece and hold on for dear life, you know? Define your risk, of course, but a few things to mention, Pardon the sloppy crayons here, but we have, let's talk about the stages. Accumulation, actually upwards accumulation, which is a really strong signal. And then boom, breakout, a little more accumulation. The kind of crescendo here, so to speak. And then this is actually interesting how high the volume is on here. It makes me think that it will want to retest this area at some point. Yeah, absolutely. I will, Miss Lucia. Thank you. We have on Palantir, I would say this could be, let me know what you guys think. It's a little complex, but it's kind of looking like, what's this? Left shoulder, head, right shoulder. Let's hone in a little more. Draw the trend line right there. We'll make that more visible. I think this is a complex head and shoulder. I think this is a great example. So it'll be hard to find a lot of these patterns right now. Cup and handle, I'll take a look at those as well. Let me see if I can think of any. I'll be completely honest, we are in a downtrend. So it's going to be hard to find continuation patterns like ascending triangles or cup and handles. And more importantly, I don't think I'd trade them because we're in the downtrend. So they could very likely fail compared to like the really high success rates that we're looking for. So we got that. Oh, and thank you. Tim is reminding me to put the thing up there. So let's see. We're talking about Palantir. Boom. Okay, I figured it out. Awesome. We are learning together. This is great. So we have the left shoulder, we have the right or the head and the right shoulder, and we have this trend line, and it's just trying its best to hold on here. It actually closed the day green, so it's showing a lot of relative strength. And like I said, these aren't the most reliable patterns, head and shoulders. They have about a 55 to 60% win rate. But if we do see it, what we'll be looking for is a close under this neckline and the expansion down there. Real quick, cheeky peeky, fun name. Yes, these absolutely apply to futures. I used to be almost 100% a futures trader. You'll see them constantly. Absolutely. And more than that, it isn't on the weekly or the daily. It's on all time frames. You can pull up, Tim can pull up his 15-second chart and we'll still see the same things form out. And it's all because it's the just how price manages to sweep a range. Alrighty. So there's the neckline. We're going to be looking for a break below this and a break below this low too. We can just move this line a little bit down there just for the sake of convenience. So if you see Palantir trading under also the whole number, the round number 80, that's a good sign to short. And what I would be targeting is all of these imbalances, all these gaps between these candles. That's what we call poor structure. You're into 5-second charts now, of saying, oh, these kids these days, I know you're older than me, but I can't keep up. Anyways, we will be looking for a sweep down into here, a nice powerful move down. Maybe it backtests the handle and then cleans up all of this stuff. So that's something to keep in mind for Palantir. Thank you for your question. And let's move on to, I know Stuart had one. So when you mention about the distribution phase in the stages, could that end up breaking to the upside? Yeah, I can. Let's see. I think I have an example of that too. What was it? So when you get a failed breakdown, it's often one of the strongest bullish patterns. So I am not sure if I can find an example here. Yeah, I found one. Perfect. So, all right, guys, what do you see in this area? Somebody drop it in the chat. What do you see in this area? What pattern did we talk about today? Or the inverse of that pattern? Wink, wink. Let's take a look. We have left shoulder, head, right shoulder. But what happened, guys? It mooned. Like I said, these moves can be really powerful, and that's why it's important to zoom out and see the larger context. This is a big old base. So yeah, there you go. And somebody said Eve Apple, that's very interesting because now I'm seeing it. And I think it broke one rule because you have the V and you have this curl, but the Eve broke the bottom of the atom. That being said, clearly it did go up, right? So like I said, there's always an art to it. There's always a give and take. But this is a great example of a bearish pattern that failed to break the neckline, our line right here, tried, consolidated, then moved up. It even tried twice, but it wasn't able to get juice down. And what it did is it just exploded upward. And how we can kind of conceptualize that is everybody's looking at this head and shoulders. Everybody's like, oh, we're going to the depths of hell. Well, they're going to get, if they're wrong, they're wrong, right? This is SMH, and chips were going crazy for a lot of fundamental reasons as well. And when they capitulate, they have to buy back their shorts essentially, and they chase it up and up and up and up and up. And then new longs jump in and add fuel to the fire. And that's how you get squeezes. And as we see, boom, big old squeeze. So that's a great example. Thank you for your question. Let's see. What else do we got? Reddit. Yeah, let's do Reddit. Perfect. Reddit. Fun company, fun AI stock. Ooh, I have a bunch of old scribbles. That played out well. I was like, where's my chart? What's going on? That's what happened. Big gap up. Okay. Let's talk about it. First, let's zoom out though, because we go from high time frame to low time frame here. So that's a heck of a move, right? That's a crazy move. First off, let me clear these drawings out, or at least clean this up so you can see. Actually, this is perfect. Look at this. We have a cup and handle in the base, and we also have, what's this? What's this, guys? A V and then a curl. V and then a curl. I know you can do it. V and a curl into a sharp move. The Adam and the Eve. And big expansion out of that. So we have a big trading range. We slap a fib on that range. We are watching the equilibrium to see if this is a bullish chart. Then there you go. Stuart with the Adam and Eve. You got it. We got the big breakout here coming down. We want to see what happens at the middle of that range. What happened is it flushed pretty hard. So then we have this range. And, I am going to save some secret sauce for next week, guys, because I think we're going to talk about fib ranges and there's a lot to discuss, but let's give you a little teaser here. There's a reason why I have the 0.68, 618, and the 0.78 in yellow here in gold, because this is called the golden pocket. And you will learn next week what that means. It'll be good stuff. But what the purpose of this, for the purposes of this discussion, we are rejecting this range. So to me, this says that it needs to fill in some of this, and that is on the daily chart. That's this big gap. So as you can see, they tried valiantly to defend the gap, but it just couldn't quite do it, So now we're down here in no man's land. What we are looking for is buyers to step in and show that there's a change in price action in this range. Gaps don't always fill, especially on a really strong mover like this, but what goes up must come down. I think that if I was looking to buy Reddit, I would be setting alerts at a few areas. And again, I'm going to tease more fib stuff. You can do fibs on anything. Let's draw a fib in the gap. Whoops, there it goes, in the gap. And now I would pop my line on the equilibrium or the 50%. I want to see what price does when it's halfway through the gap. So that's 93.50. That's a good level to put an alert at. And if that bounces, that's great. But I think more like what we're looking at is in this golden pocket. So that is, let me lean in and squint. 87.50 is an area of interest. That's right in the smack dab middle of the golden pocket. And we can talk more about all of these levels. And actually, I'll use Reddit as an example next week as well. But really what I want to see is this. I really want to see the gap closed. I think that it's quite likely that it needs to, because we're in a downtrend. This is a very risk-on, high beta stock. High beta means it moves a lot more than SPY. When SPY goes down, it goes down more. And because of this, we gotta be cautious, right? I will say, devil's advocate, it is posting bottom wicks here when it's in the gap. So there are people buying it. Remember I said there are orders waiting in here. So there are people buying it. They could be wrong. All I'm going to say. So great example. Appreciate that. And let's see. anybody has a last question here, I'd be happy to take one more. Otherwise, I think we were close to bottoming here, or close to being done here. And let me see. While I wait for that to filter in, I will try to find some of these patterns that we talked about right now. But like I said,
I think we had a few from Miss Lucia.
Yeah, absolutely. Unfortunately, that's the thing. When we're in a downtrend, it's going to be hard to find these bullish patterns. So this is kind of more in preparation of what we are going to see play out. I could flip charts upside down for you and find some, but let me see. Let me quickly go through some. Yeah, all of these are just starting to break down. Tesla showing life. Interesting. What was that? UNH? There we go. Yeah, we can talk about a few of the healthcare names, I think. Might be able to find something in there. So this is a little sloppy, but we can talk about this. This will work. We have, to some degree or another, some ascending wedges here. So that's kind of a little ascending wedge. It's a little bit of sloppiness with the overshoot, but as you can see, big expansion up. And then what we can do, let's measure the base to the top of this. Oh, and as you can see, that's actually the exact measured move of there. These things are very algorithmic. So if we double this, that's just about our target, and it hits, and boom. We can also draw one right here. There's another little ascending wedge, right? And so that's why these are continuation patterns. When you're coming out of the bottom, X, yeah, let's talk about X in a sec here. And then I got to wrap up, but I appreciate all these questions. So we have the rising support, we have the flat hard top resistance, and then boom, big breakout here and measured move. From the base to here, we double it. And as you can see, hits pretty easily. So last chart here, let's talk about X. United Steel, I love the company. Oh, they had a tough day. They had a tough day. So I will be completely honest. This chart is hard to play. As you can see, all of my crazy schizo scribbles on here. Hi, Island Girl Forever. Thanks for tuning in here. We are just wrapping up, but I will be back next Thursday and the Thursday after that, and hopefully a whole lot more Thursdays. As long as you guys keep tuning in, I will do my best to keep doing them. I do love it, and I appreciate you all being here. So X here, it's a tough chart to trade. I got crazy schizo scribbles all over the place. There's a lot going on. So let's see. I don't want to remove all my drawings right now. It's tough. It's tough. On a high time frame, it looks like a big cup in a complex handle that failed a breakout. So like I said, bearish patterns that fail are often really bullish. Bullish patterns that fail can be pretty bearish. So I'm going to keep an eye on it. It might need to revisit the bottom of this trend line here. And I know that would smoke a lot of people. I will say that why this is so hard to trade is because there's a lot of macro and geopolitical news and like just, headline risk with this name. It being in the middle of an acquisition deal or potential acquisition deal. I believe if it does pass, it's valued at least $54. There's also the factor that we have steel tariffs going on. So there's a lot of potential for these names to really pick up steam if we start getting some volume and some bids and some constructive price action. Right now, unfortunately, I'm not really seeing it, to be completely honest. So good name to look at. Let's see if we can find, maybe that's a left shoulder and this is a complex head and this is a right shoulder that could form. See your comment a few messages ago. Let's see. Not sure which one you're referring to. I'm sorry. Yeah, I see the Adam and Eve double bottom on Palantir. Yeah, absolutely. Absolutely. Great eye. You guys are learning. I love it. This is what I'm here for. This is what I'm here for. And I learned from your comments as well, so I appreciate that. SPY. Oh, SPY. Yeah, okay. Let's do SPY and finish up on SPY, guys. That's great. I won't take too much of your time. I really appreciate everything here. Let's talk about what we're seeing. This is an old drawing, not too old, but once we put in this low and then rejected up here, I was projecting the measured move like we're talking about. This length is the same as this length. Stuart, I really need to, let me throw it up on screen. Oh, you got it already. Perfect. I really need to zoom out and look at the patterns. It can make such a difference. Absolutely, Stuart. It's all about the big picture. And what we do is we take the big picture, we get our perspective on that, our bias, and then we go smaller and smaller and smaller. And that really helps us get to the point where, like, okay, I know what I'm looking for in a trading day. I know the levels I want to get in on. I know the levels I want to get out on. It takes away so much guesswork, and it frees up the mental capital to allow you to look for that next trade and to book the profits and to do this consistently and successfully, because that's what it's all about. There's so many variables, especially when you first get started. So it's really important to figure out how to hone it in and how to get it to a thing that's almost mechanical, you know? And also that helps take the emotion out of it, because, you know, it's just another day at the office, you know? Maybe not today. Today was a little bit of out of the normal. Big money in X, Lucia mentions. Absolutely. You know, I'm also watching the flow on that. That's another topic we can talk about. Flow, what it is, how to read it. If anybody has suggestions of topics they want to hear about, feel free to add those in the comments as well, or message me on Discord. I'm very open to that. So yeah, this is all really good stuff. I am watching X. It's big flow for sure. And there is a potential deal around the corner. The tough part is I can't recommend it from a charting perspective, but that doesn't mean that it couldn't pass tomorrow and U-turn the whole thing, right? So that's kind of where I'm at with X. As far as SPY, what I'm looking for is there's a little gap here, and what's really important is this super high volume capitulation low, like we were talking about. This whole capitulation move here was from the yen carry trade unwind. I will not bore you with the details, but suffice to say it was very important, and it shook out a lot of weak hands in the market. So it filled a gap, it came back, and then it just ripped and, you know, did this whole crazy thing. So the important thing to note here is we have confluence between the size of the measured move that I'm projecting and this very, very key level. So I think that there's quite a high chance that we trade down here. Nothing's certain, nothing's for sure. You know, this is another, as you can see, this is another target and level I had. It hit a little faster than I was expecting. Quite a move, guys, I will say. But hey, I did catch it, so I'm happy about that. And I am still short. That being said, we could come back up a little bit, but I'm believing that we're heading down here. So that's my kind of general outlook on SPY. And yeah, I think that we're in for some rough stuff with all the tariff news and everything. I think that it's going to take time for that to be digested and probably rolled back. So until we get a catalyst, which could be as soon as I believe there's jobs numbers tomorrow, and then some Powell speaking on Friday. So we've got a lot of potential catalysts for some up and down action. But the bottom line is, unless we reclaim this high, which actually coincides with the 200-day moving average very cleanly, maybe it's a little bit lower, that is going to be our signal for for a potential bottom. But until then, I think that we go significantly lower. Don't want to say it, but I do believe it, and I wouldn't lead you guys astray. So that's where I'm at. And yeah, with that, let's wrap up. I really appreciate you all for tuning in. I definitely went over time here, but it means so much that you guys stuck with me and asked questions. Makes me feel like I'm doing something right and like you guys are getting something out of it. So I really appreciate that. And yeah, I hope to see you back next time. I will answer this one last question before I go here. So Stuart, appreciate all your questions, man. Great advice. Can we get back testing patterns, or can the back testing patterns still be applied to small caps and penny stocks too? They can be so volatile compared to large cap stocks. Absolutely, they can. You will see more overshoot of necklines, for example, more shakeouts, less perfect patterns, because they're easier to get pushed around with low volume environments like that. But they still work. They still do work. It's just a little bit less clean. So I'm not saying don't do it, but just keep that in mind. All right. Thank you so much, guys. This means a lot. I really appreciate y'all tuning in, and I hope you have a really great week. Take care now.